You're staring at a spreadsheet of last year's fees, trying to figure out what to charge this season. One client paid $350 for what felt like a simple return. Another paid $1,200 for something that took the same amount of time. And you're wondering, how do I possibly turn this mess into a consistent pricing structure? If you've ever said, I just need to see how complicated it is before I can quote a price, this episode is for you. Hey friends, welcome to the Thrive Advisor podcast, where we help tax advisory firm owners build practices that are sustainable and profitable. I'm your host, Aaron Siegel. Today we're tackling a topic that keeps advisors stuck in feast or famine mode, the fear of fixed pricing. Specifically, the paralyzing belief that moving away from pricing by the form means you'll somehow lose money on every engagement. By the end of this episode, you'll have a practical framework for building tiered pricing from your own historical data, the psychology behind why this works for you and your clients, and permission to stop treating every return like a custom art project. Let's get into it. So here's what I hear all the time from advisors. I can't charge a flat fee because I don't know how complicated it's going to be until I'm in it. This logic seems airtight. Every client is different. Some have one W-2 and a standard deduction. Others show up with 3K1s, a rental property, and a side business they forgot to mention. How could you possibly charge the same price? But here's what this thinking actually creates: anxiety for you and uncertainty for your clients. You're stressed because you're constantly doing mental math during every call. Is this a $500 situation or a $1,500 situation? And when you finally send the invoice after the work is done, you're either apologizing for the price or kicking yourself for not charging more. And here's the thing, your clients hate this too. They have no idea what they're walking into. Call me when it's done and I'll tell you what you owe is not a business model. It's a hostage situation. No wonder they push back on your fees. The form-based model also punishes efficiency. If you get faster at preparing returns, you make less money. If you invest in better software or hire someone to handle data entry, your revenue drops because you're still charging by the hour or with a form. You've built a system that literally penalizes you for getting better at your job. I've always used flat rate pricing in my own practice, but I saw form-based pricing in action when I worked at one of the big box tax shops early in my career. I hated it. Clients hated it. Every invoice was a surprise, and not the good kind. Someone would come in thinking they had a simple return, and then we'd add a Schedule C, a rental property, state filing, and suddenly they're staring at a bill 3 times what they expected. The look on their faces told me everything I needed to know about that model. And let's talk about the other side of the equation for a minute, because understanding this will make the transition easier. Your clients aren't buying tax returns. They're buying certainty. They're buying the confidence that their taxes are handled correctly, that they won't get a surprise letter from the IRS, and that someone competent has their back. When you say, I'll let you know what it costs when I'm done, you're introducing anxiety into a relationship that's supposed to reduce anxiety. That's backwards. Think about it from their perspective. They're already stressed about taxes. Now you're telling them that they won't know the price until after the work is complete? That's like going to a restaurant where the menu has no prices and the server says, we'll tally it up when you're done eating. Nobody wants to eat there. Price anchoring research shows that people make better decisions when they have reference points. When you give someone 3 clear options with 3 clear prices, they can evaluate what they're getting at each level. They feel in control. They appreciate the transparency, and counterintuitively, they often spend more than they would have with an uncertain quote because they can see the value they're getting. The middle option, by the way, is where most people land. Psychologists call this the Goldilocks effect. The basic option feels too stripped down. The premium option feels like overkill, but the middle one feels just right. You can use this to your advantage when designing your tiers. And here's where we get practical. Before you can build tiered pricing, you need to know what you've been effectively charging. Pull up your billing records from the last 2 or 3 years. Export everything into a spreadsheet. Every client, every service, every fee. Now, sort it by price from lowest to highest. What do you see? For most advisors, you'll find one of 2 patterns. Pattern 1 is tight banding. Your prices cluster in a relatively narrow range. Maybe 80% of your clients paid between $900 and $1,300 for their returns. There are a few outliers on either end, but the bulk of your work falls within a predictable band. If this is you, we've got a 3-tier pricing situation. Your clients have similar complexity, so you're not pricing for different levels of work. You're building 3 service tiers around consistent work. Bronze for pure compliance, silver for added advisory touches, gold for premium access. Your historical clustered price becomes your bronze anchor. And then pattern 2 is multiple clusters. So your prices might group into 2 or 3 distinct bands. Maybe you've got a cluster around 600, another around 1200, and a third around 2000. These represent different levels of complexity in your client base. If this is you, you'll need what I call the 9-box model. Those clusters tell you that you're serving clients with genuinely different complexity levels. You've got 3 complexity bands, and within each of those bands, you offer 3 service tiers. So bronze, silver, gold. That gives you 9 pricing cells that cover virtually every situation. Now, if your data doesn't fit either pattern, if your prices are scattered all over the map with no clear clusters, that's a different signal. It usually means you're not niched tightly enough. When you serve everyone, every engagement becomes a custom build, and you can never develop repeatable systems because nothing repeats. So the fix there isn't a pricing framework. The fix is narrowing your focus until your clients start looking similar enough that you can systematize the work. That's a different episode, but it's worth mentioning because no pricing model will save a practice that treats every client as a one-off custom project. Let's start with the simpler case. Your data shows tight banding, and you want to build 3 tiers. These clients have similar complexity, so we're not pricing for different levels of work. We're pricing for different levels of service and the advisory touches. So first, we're going to anchor our bronze tier to the historical cluster price. So if most of your clients paid around $1,000, that's your bronze. This is critical. You don't want to cut your revenue by having everyone drop to a lower price point. So your bronze tier should capture what you were already getting for that core work. Your silver tier should be around 35 to 50% higher. So if your bronze was $1,000, silver might land at $1,500. And this is going to add some core advisory elements, maybe a planning conversation, maybe some proactive tax projections, but that's it. And then your gold tier should be at least 50%, but probably 75% higher than your bronze. So let's call it $1,750. This includes everything in silver plus some premium touches. So priority response times, front of the queue access, maybe a mid-year or quarterly touch points, and then year-round access for quick questions by email. So the key here, though, is that each tier needs to feel like a natural step up. The jump from bronze to silver should feel worth the difference. And then the jump from silver to gold should feel worth the difference. If clients can't see why they'd pay more, they're all going to cluster at the bottom, and that defeats the purpose here. So here's how I think about differentiation. The bronze tier is about pure compliance. You're doing the work correctly and on time. The silver tier adds some advisory elements, that brief planning conversation, quarterly check-ins. The gold tier is really about access and proactivity, so faster responses, more frequent touch points, concierge level service. We're really adding the intangibles here. And notice that the complexity isn't the differentiator here. Everyone in this model has similar complexity. So what changes is the level of service and planning wrapped around it. You're adding those intangibles. You're not handling harder returns. If your data shows multiple distinct clusters, you need the 9-box approach. Think of it as a grid. So across the top, we're going to have our bronze, silver, and gold. And then down the side, we're going to have our simple, moderate, and complex. Each cell has a price. So a simple return at good might be $600. A complex return at best might be $3,500. The complexity axis is about scope. So a simple return might be a W-2, some interest income, maybe a small side hustle. Moderate's going to add rentals, significant investments, or multi-state filings. And the complex would involve your business entities, multiple K1s, or just unusual situations. Our service access is about the experience. So bronze is straightforward and efficient. Silver adds some more touch points, and then gold is full concierge with priority access. So when a client comes in for a proposal, we're placing them in one of those 3 categories of complexity. That's it. We're providing them 3 options, not infinite custom quotes. And you can make that decision in a discovery call just based on a few targeted questions. The beauty of the 9 box is that it handles that natural variation without requiring custom pricing for every situation. A client with a rental property might fit in the moderate complexity band, but whether they land in good, better, or best is up to them based on how they want to be served. The price is clear before the work begins. Here's where the Pareto Principle comes in, and it's the mental shift that makes this whole thing work. So the 80-20 rule tells us that roughly 80% of effects come from 20% of causes. In pricing terms, this means you're not trying to optimize every single engagement. You're trying to optimize the bulk of your work. When you set tiered prices based on historical data, you're pricing to the middle. Some clients will be profitable, some will be less profitable. The goal is on average, across your client base, you come out ahead. And this is a fundamentally different mindset from form-based pricing, where you're trying to capture the exact right amount for every single return. That precision is an illusion anyway. You're guessing. You're often wrong, and the cognitive load is exhausting. With tiered pricing, you accept that you'll win some and you'll lose some. The return that turns out simpler than expected, that's a win. The return that turns out more complex, you might come out a little behind. But over the course of a season, over dozens or hundreds of returns, it balances out. The key is getting rid of the outliers. If you have clients who are wildly unprofitable under any pricing structure, they're either in the wrong tier or they're not a fit for your practice. Refer them out kindly. Don't torture yourself trying to create a pricing tier that makes a terrible fit client profitable. Some clients just need to go somewhere else. Focus your energy on your bread and butter. The 80% of clients who fit your system, who can be served repeatably, who fall cleanly into your tiers. That's where your profit comes from, and that's where your sanity comes from. I want you to think about McDonald's for a second. McDonald's serves millions of customers every day. They don't have a different price for every cheeseburger based on who's ordering it. They've got a menu with set prices. You know what you're getting and what it costs before you order. Now, could they theoretically optimize their revenue by charging each customer the maximum they'd be willing to pay? Maybe, but the operational complexity would be insane. Instead, they price based on what works for the bulk of their customers and accept that some people would have paid more and some would have paid less. Your practice can work the same way. When your pricing is consistent, you can train team members to quote without needing you in the room. You can project revenue based on your client count and the tier mix. You can focus on delivering great work instead of reinventing every proposal. The firms that scale are the ones that figure out how to make their work repeatable. Tiered pricing is a huge part of that. When every client is a custom build, you can never develop systems. When clients fit into defined tiers, you can build templates and processes that work every time. So how do you actually roll this out? Start by doing the historical analysis I described. Pull your data, sort by price, look for patterns. Decide whether you're going to have 3 levels of complexity or 1 level of complexity. Build your tier structure. So define what's included at each level. Price each tier based on what your data tells you, not what you wish you could charge or what you're afraid clients won't pay. Let your numbers guide you. For existing clients, you have options. You can grandfather them at the current pricing until their next renewal. You can have honest conversations with them about the new structure. You can offer a transition discount for the first year. But what you shouldn't do is keep 2 pricing systems running forever. That defeats the entire purpose. And for your new clients, we just use the tiers from day one. When someone calls for a quote, we ask enough discovery questions to place them at a level of complexity. You present the 3 options and they choose. No more, let me get back to you after I see the documents. And some advisors worry that their clients will revolt. In my experience, the opposite happens. Clients appreciate your transparency. They like knowing what they're paying before the work starts. The ones who push back the hardest are usually the ones who are getting a steal under the old system. And honestly, those might not be the clients you want to keep anyway. Before we wrap up, let me address the objections I hear most often. But what if I undercharge on a complex return? You will. It's going to happen. And you need to be okay with that. Remember the Pareto math. We're not optimizing every engagement. We're optimizing the portfolio. That one return where you came out behind is balanced by 3 others where you came out ahead. Stop trying to win every single transaction. Win the year. But what if clients game the system and hide their complexity? First, your discovery questions should catch most of this. You're asking about businesses, rentals, investments, foreign accounts. If they lie, that's on them. Second, your engagement letter should include a scope clause. If the return turns out to be significantly more complex than they disclosed, you can adjust or refer them out to someone else for next year. Next, but what about the clients who are simple and I'm overcharging them? Are you though? Your base tier exists for this reason. If someone genuinely has a simple situation and chooses the base tier, they're getting a fair price for straightforward work. If they choose a higher tier anyway because they value the additional service, that's their choice. You're not forcing anyone into anything. But my clients all have different situations. Yes, within a range. If you've niched properly, your clients should have similar profiles. A locum physician has different needs than a clinic owner, but locum physicians as a group have pretty similar tax situations. That's the point of niching. You're not serving everyone with taxes. You're serving a specific type of client whose needs you understand deeply. But I've always done it this way. I know, and it's been stressful, hasn't it? The custom quoting, the mental math, the invoices that clients push back on, the feast or famine revenue. The way we've always done it is not a business strategy. It's inertia. The fact that something is familiar doesn't make it optimal. Look, I'm not saying this framework is perfect or that it works for every possible practice. What I'm saying is that it works better than guessing. It works better than custom quoting every engagement, and it works better than the uncertainty and stress that comes with pricing by the form. And it's not even that hard to implement. You have the data. You just need to look at it with fresh eyes and build a structure around what it tells you. Here's what I want you to take away from this episode. You do not need to capture the perfect price for every single return. You do not need to know exactly how complicated something will be before you can quote it. You do not need to treat every client like a unique art project that requires custom pricing. What you need is a system that works for the bulk of your clients, generates consistent revenue, and frees you from the mental exhaustion of endless custom quoting. Tiered pricing does this. It is not a perfect system. No system is perfect, but it's a huge improvement over the chaos of form-based pricing or hourly billing. And here's the thing. You can adjust as you go. Run this for a season. See where clients fall. Notice which tiers are profitable and which need adjustment, and then refine based on real data, not speculation or fear. The goal isn't to get it perfect on the first try. The goal is to have a system that you can iterate on. Right now, you don't have a system. You have a guessing game. An imperfect system beats no system every time. Tax season is coming. We have a few weeks to figure this out before the rush hits. So pull your data this week, build some tiers next week, and test them on a few clients. By the time next tax season rolls around, you could be quoting new clients in 10 minutes instead of agonizing over custom proposals. You could be projecting your seasonal revenue with actual confidence. You could be running a practice that feels like a business instead of constant improvisation. That's the prize. It's worth the work to get there. If you're ready to build systems with advisors who get it, come join us in the Thrive Advisor Collective on School. The link is in the show notes. If this sparked a light bulb for you, share this episode with another advisor who's still pricing by the form and needs a push to make the switch. You've been listening to the Thrive Advisor podcast. Work smarter, serve better, thrive always. We'll see you next time.